Most people don't stay poor because they're lazy. They stay poor because they run a decent income through a terrible system. You could be on $80,000, $120,000, even $200,000 a year and be one missed pay away from absolutely panicking. If you keep doing what everyone else is doing with their money, then you'll end up like the majority. So this isn't a video about getting rich overnight. This is about how to make sure you're not poor forever and how to make sure in 5, 10, or even 20 years, you're still not living paycheck to paycheck wondering where it all went. So today I want to give you a real life blueprint. This is not the skip coffee and you become a millionaire type video. It's just simple, boring, repeatable things like stop the leaks, build a safety net, grow your income, get you investing, put property in the right place of your plan, and give you a money system that doesn't rely on motivation. If you actually do this stuff, it will be very hard for you to stay broke long term. So just some quick context so you know where I'm coming from. I'm a mortgage broker based in Melbourne. I've seen hundreds, if not thousands of bank statements, budgets, and loan applications. I see what people say they do with their money, and I see what actually happens when the numbers hit the page. I've also made a whole heap of mistakes myself. I've had lifestyle creep. I've bought things because I think I deserved it. I bought my first home in my mid-20s thinking it was my 10-year plan. Life changed so fast I had to sell it within 2 years. And then I realized how important it was to have a bigger financial strategy than just buying a house. So what I'm sharing isn't just theory, it's a mix of what I've done right and what I've done wrong and what I see over and over again with all of my clients. So here's where we're going. Stop leaking money, build a safety net, grow your income, start investing early, buy property when you're ready, and build a money system. You need to fix your environment and your expectations on how your money is managed. And if you only remember one idea from this whole video, just let it be this. You cannot win with an average income and average behavior. Something has to change. Okay, let's start where most people lose from the beginning. Before you fix your income, before you invest, before you even think about buying property, you have to stop pouring water into a bucket with 10 holes in it. For most people, the holes look like this. Afterpay and buy now, pay later facilities, credit cards that roll over on interest every single month, car loans that don't really serve a purpose, online shopping just because it was on sale, and lifestyle upgrades every time your pay goes up. The truth is, bad debt and feeling like you're getting a quick win is going to keep you poor. If you can't buy it straight up, you simply can't afford it. If you wouldn't take out a loan for it, you shouldn't afterpay it either. And this is the pattern that I see. Income goes up, lifestyle goes faster, savings stays the same, and your stress will actually increase. So step one of not being poor forever is simple. Kill your bad debt. Stop creating new bad debt. Give yourself a boring 6 to 12 months where the only goal is to get back to $0, get back to an even playing field. It's not the most glamorous of journeys, but you can't build a house on a rocky foundation. Next, you're gonna need to build yourself a safety net. Once you stop sinking, you're gonna need a life jacket. For me, the minimum baseline of I'm not financially cooked is 3 months of expenses in your cash or offset account. You have no afterpay and no personal loan debt and a basic plan for your money each and every pay. The 3-month buffer I think is so important because it means if you lose your job, you have some runway to get yourself back up again. If your car dies, it's not an inconvenience nor a crisis. If something goes wrong with your health, you're not instantly reaching for that credit card. Most people underestimate how much this will reduce your anxiety. We talk a lot about financial freedom, but honestly, financial stability is the step that everybody skips. You don't need $1 million to feel safe. You need enough so that one bad month doesn't wipe you out. Your buffer is not extra savings that you might dip into. Your buffer is non-negotiable infrastructure for your finances. You protect it the way that you protect your rent or your mortgage repayments. Once that is in place, everything you do with money becomes a whole lot easier. Now we're going to talk about the part that nobody can budget their way around. You cannot cancel your Netflix subscription into wealth. You cannot unsubscribe your way into financial freedom. At some point, you have to face this. You can't win with an average income. Now, that doesn't mean you need to become an ultra high net worth CEO, but it does mean you can't ignore your purchasing power. And I think about income in 3 moves. Move number 1, know your market value. Most people have no idea what someone in their role should be earning. You should be looking up job ads in your field. You should be talking to recruiters and ask people you trust in similar roles. If you're being underpaid by $10,000 to $20,000 a year, which is extremely common, that's a massive drag on every goal that you have. Move number 2 is going to be more valuable, but do it on purpose. I'm not talking about grinding 18 hours a day for work just because you're asked to. You need to ask yourself, what skills will make me 20% more valuable in the next 12 months? For a lot of young professionals, that's things like better communication, owning a part of the process at work, learning a higher value tool or system, and taking on work that directly ties to revenue or outcomes. If your skill doesn't move, your income won't either. It's much easier to ask for a pay rise after you've shown your value rather than asking for a pay rise before you've done anything to benefit the company at all. Move number 3 is use career moves, not just side hustles. Side hustles get a lot of the attention, but for most people, the biggest jump comes from actually asking for a raise with proof of results. You could move to a better paying company every few years and being willing to step outside of your comfort zone in that particular role or industry. The extra income will only help if your behavior changes. If your pay goes up and your lifestyle goes up with it, you just become a high earner who's still broke. So again, you still need to plug the leaks, you still need to build the buffer, then you need to push your income. It's not the other way around. Once you've cleaned up your debt, started a buffer, and you're working on your income, you need to get your money working for you. Now, I'm not an investment advisor, but I'll tell you how I think about it and what I'd research if I was starting all over again. For most people, something simple like broad ETFs or index funds is a really reasonable place to start when you're learning. Even using an app like Raise or something similar just to build the habit to see how the markets move. A principle that I live by is risk is not investing, risk is waiting. Let's say you start at 21, you put away $100 a week into a simple portfolio on one of those apps like Raise. Over the long term with reasonable returns, by the time you're 40, you're looking at well over $200,000 invested. Not because you picked the perfect stock, but because you started early. But to do this, you need to make sure you stay consistent, you don't keep pulling money out, because that's the game. You don't need to be a genius, you just need to be in the market and let time do a lot of the heavy lifting. Now let's talk about the big one for most Australians. It's buying property. Buying property will be the biggest asset that most of you will ever buy, and it is the main way that you will build your wealth. But here's where people get stuck. They rush to just buy anything. They think because owning is automatically better than renting. They treat owning a home as the finish line, not a strategic move inside of a much larger plan. Property can be absolutely amazing. It's for savings, it's a long-term hedge against inflation. You can use leverage to grow faster. than you could ever do saving alone. But it can also lock you into big mortgage repayments, a suburb you might not even like, and no flexibility if your life changes. When I bought my first home, I genuinely thought this was my 5 to 10 year house. I built it, planned my life around it, and then life changed rapidly. My relationship changed, my work changed, and I ended up having to sell within 2 years. Now, I made money, so I don't really regret it, but it taught me a lot about my 20s and early 30s. Flexibility can be the most valuable thing you have. Owning at any cost is not the name of the game. So in this blueprint, property is not step number 1. Property comes after you've killed bad debt, you've built a buffer, you've started investing, you've grown your income a bit, and you understand your numbers. Then you can ask yourself, do I want to buy a home to live in or rent where I love and buy an investment where the numbers work? Both can for sure build wealth. The dumb move is buying something that you can't afford in a place you don't love with no plan beyond the thought of, at least I'm not renting. Now we put it all together because if your money system is in your head, you don't have a system at all. I like to keep this really simple. You don't need 18 accounts and 12 spreadsheets. I want you to think in 3 accounts. It's your bills, your spending, and your savings. Inside of your bills account, we have things like your utilities, phone and internet, insurance, car rego, and your mortgage and rent payments. In your spending account, this is things like groceries, eating out, entertainment, day in the life sort of stuff. This is your guilt-free bucket. Next is savings and investing. Think things like your house deposit, the emergency buffer that we've been talking about, and investing into that ETF or portfolio. The way you use them matters a whole lot more than the labels. Start with a goal. Let's say you want to save $20,000 in a year as a couple. Work backwards. $20,000 across 52 weeks is $385 per week. So every week, $385 has to go straight into that savings and investing account. Non-negotiable and automated. Then you look at your fixed costs, add up 12 months of rego, insurance, and utilities, break that into per pay amounts. Every pay, you move that into your bills account. So when your $900 rego shows up, there's already money sitting there. There's no panic, no how did this happen, you've planned for it, and what's left after you deal with those 2 things becomes your spending money. That's how you stay disciplined and still have a life, as well as avoiding a giant surprise bill destroying your progress. It's not about tracking every $3 coffee. It's about building rails for your money to run on. So if we strip it all back, how do you not stay poor forever? First, you kill bad debt, you build yourself a buffer, grow your income on purpose, start investing early even with small amounts, use property as a tool, not a personality, and build a money system. You don't control the economy, you don't control inflation, you don't control what your friends do. but you do control what happens the moment the pay hits your account. Most people stay poor because they never take it seriously, and you don't have to be one of them.